Morning, students.
Good morning, sir.
Morning. Am I audible?
Yes, sir.
Okay, fantastic. Sorry, was experiencing some connection issues. Finally got back on track. Who's the other login person? Manav, it says.
Yes, sir.
Okay, is this your first class?
Yes, sir.
Okay. So tell me a little bit about yourself, Manav. I know about the others.
My name is Manav, and I just completed graduation from Somaya Vidyavihar, KJ Somaya,
Yeah.
and yeah, I'm just trying means what else?
Okay, so you are new to this semester or you joined the course just now?
I just joined the course.
Oh, I see. Okay. Okay, because I don't recollect seeing you last semester. That's why I asked. Okay.
Yes, sir. Yes.
All right. Okay. Should I wait for some more time for the others to join or shall I start? Yes, students? Anyway, we will take a look at, yeah, go ahead, Nidhi.
Yeah, I think we can start, sir.
Okay,
by the time.
because I'm already about 9 minutes into the session. Yeah. I'll go ahead and start. Okay, so as you guys, as we discussed, so we were discussing the market direction possibilities last class, and we'll do that every time. So as we discussed, the market in the first part of the week tried to go up, then hit resistance near that 15,900 area. And I believe that is going to be very high resistance, which the market cannot take out. And here is why. Here is why. I will show you the graph of the Nifty. July is going to be a very interesting month. It is kind of crucial also. Can anybody tell me why I think July is crucial? Any guesses on that?
On the inflation rate issue,
Inflation to an extent, but there is something else fundamentally that happens in July.
Is quarterly results?
Yeah. Quarterly results. And I am going to bet that quarterly results are not going to be very, very, very good. I think this, ultimately, please understand, fundamentals take over long run, right? So fundamentals are the ones, earnings power is what divides stock price. I mean, is what drives stock prices. So in COVID-led scenario, when COVID happened, central banks aggressively cut interest rates. So cost of funds was very low for companies. So as a result, they were able to leverage that and make huge profits. So the market went up. Now the reverse is happening. Yes, the central bankers are taking the punch bowl away, right? They have been raising rates aggressively. You are seeing Forex dollar strengthen like anything. Last week, if you look, the rupee hit a new low, right? So when the rupee hits a new low, stock market can't go too high because companies' cost of funds just skyrockets, particularly those that are borrowing outside. So do you guys see the news that came late yesterday? I had a headline come to me, but did you guys see yesterday night's news by any chance?
As majorly, it was on crude oil, I guess.
Yes, yes. Did you catch
Yeah.
that, Nidhi? That news?
Just the glimpse. It was on deregulation of sale, domestically produced crude oil.
No, I just saw a message just before I came to class from the Business Standard saying that the government is going to slap a windfall tax on oil companies.
Yes, sir.
Is that correct? Confirmed, yeah?
Yes, sir.
So if that happens, watch out. Because guess what? Reliance is the big oil player and it is a big component of the index. And it will not go well with the market if that happens. I think this is fundamentally possibly bad news for the oil patch in general. But given the weightage that Reliance has in the Nifty, I think it can become a problem going forward. Okay, so this is the Nifty graph, as you can see. I'm going
Will soon announce. So let's look at option chain of 7th July, right? 7th July option chain says that 15800 has 30 lakh calls, 15800 has 30 lakh puts also. 16,000 has 32 lakh calls. Matlab, this is even Steven, right? What is there to look at it at such an early point in time? PCR is 1.06 bullish, but this is all day one data. So I think we should not read too much into it. We should ignore it. The important part here is, of course, FIDI data. I pray to God they have. Thank God. There are 2 times as many puts as calls. This we can ignore because this is the expiry related long and short, but net it doesn't make sense. Futures they have shorted 1200 crores, stocks they have shorted 1100 crores. So we can say both around 1200 crores, right? 1200 CR sell and 1200 CR sell. Options 2x puts as calls bearish, right? This is bearish, this is bearish, this is bearish. Basically, nothing changes. Long term bearish. Sorry, there's no long term bearish. I think this is today at 15,900. Or let me put it this way: sell on any uptick opportunity as long as Nifty is below 15,700. Because the weekly will also become a weak candle, right? I don't think we'll get a opportunity short tomorrow at 15,800 levels because at least US markets it looks like a very bad opening tomorrow. So my trade is sell long term calls and sit on it. I mean, I think this has been our trade forever, right? So there's nothing new. But I think if there's one thing which deserves attention for discussion today, that is dollar. Dollar tomorrow likely is to go further, and I think we might see panicky levels of dollar. It will also become very volatile because if dollar goes to 79, 50, 80 levels, यार दिखाने के लिए तो और भी
in the money option. And in the money option is one which has both intrinsic value and time value, which definitely has intrinsic value. At the money option, what would be the intrinsic value? Call option or put option? Zero. Exactly zero intrinsic value is at the money option. So there will be only time value left. Similarly, an option that in which the market price is greater than the strike price, right? For a call option, the market price is greater than the strike price is called the in the money option because it will have intrinsic value. Any option, call option, which has intrinsic value is the in the money option. Yes. Okay, students.
Yes, sir.
Any call option which has intrinsic value, which market price greater than the strike price, that is called in the money option. Okay, students.
Yes, sir. Yeah.
And what about out of the money option? In this case, strike price is greater than the market price for a call option. So an out of the money option will have only time value and no intrinsic value. Both at the money and out of the money options will have no intrinsic value. There will be only time value. Yes. Am I clear, students?
Yes, sir. Yeah.
So for the put option, it is the other way around. An intrinsic option that has intrinsic value will for a put option would be an in the money option. So what will happen here? Strike price will be greater than the market price. So from the screen, students, can you tell me which option is out of the money for a call option?
The 440,
Yeah,
460, and 480.
480. Yes. And how about put option? Which of them are out of the money?
380, 400, and 420.
Very good. Very good. And in the money would be for call option?
In the money would be 380,
Yeah.
400, and 420.
Correct. And in the money put option would be?
440, 460, and 480.
Correct. So you got the concept of in the money and out of the money options, right?
Yeah. Yes, sir.
Now, there is a very good statistic that tells you that most options go worthless. Yes. So who's making money? The exchanges are making money. And most out of the money options go worthless. Yes. But the temptation is, obviously, you are going to buy low. So the temptation is to buy low and buy out of the money options, thinking you will make money. But guess what? If the market doesn't move, your out of the money options will go worthless, right? Yes.
Yeah.
Remember, your out of the money options only have time value. Yes. They don't have intrinsic value. So for them to get in the money, the market has to move in your direction. So if you think you think Google is going up and you prick the 460 call, for you to be having any intrinsic value, Google should cross 460, right? But what if it just at the expiry comes to 459? You'll still lose the 355 that you bought it with, right? At expiry, options which are out of the money will have zero value, right? Yeah.
Yeah. Yes, sir.
So that is the reason people lose a lot of money in options, because they will trade out of the money options. So Mahesh, what type of options you trade?
I traded in 3 types.
No, but what options you trade? In the money, out of the money, or what?
No, sir. 3 types I traded actually.
Okay. So if you are trading out of the money options, sometimes you will get good profits. You should exit immediately.
Yeah.
Option trading, you should not buy and hold. I make this mistake all the time. Sometimes I buy and hold thinking the price would move in my favor. Remember, it can move in your favor, but it has to move before the expiry date. If not, you're finished, right? So that's something that you should keep an eye on. So I will illustrate video.
Sir, I have a question, sir.
Yeah, please.
Related to the time value portion. So usually if the months, or if the I mean, as the time passes, usually the value decreases, right? So here in this case, August, September, and I think October, right? So the time value amount is increasing, right? Sorry, December, yeah.
Yeah. So if you have more time value, your if you have more time, your time value will increase.
Okay. So, oh, okay.
because you have more time for the stock price to go up or down, right? So
Okay.
as you have less and less time, your time value will decrease.
Okay. Yeah, okay.
Is that clear?
Yeah.
Any other doubt?
No, sir, nothing on my end.
Okay. So let me see if hold on. So we'll look at a video and see what this implies.
You know, there are just some things you can't say on television. If you suspect that your advisor is not telling you the whole story, or there are some things that maybe Wall Street
In order to understand what options are, let's start with an example. Meet Zoe. Zoe has a car. This is Bill. Bill requests from Zoe to give him the right to buy the car from her at $15,000 in cash anytime during the next month. Zoe might agree on the condition that Bill pays her 2% of the value of the car, which is $300, for waiting out the month without a transaction. Zoe cannot sell her car to anyone else during this waiting period. Bill does not have to buy the car in this time frame, but he does have the right to do so. Let's look at the definition. An option is a contract allowing the recipient the right, but not the obligation to transact a known transaction, buy or sell, of a known asset at a known price in a known predefined time frame. A contract, the option agreement between two parties. A recipient of the option right. In our case, it's Bill, also called option buyer or the option holder. A known asset, the core of the option. In our case, it's Bill's opportunity to buy a car from Zoe. At a known price, $15,000, also called strike, and $300, which is the price of the option. In a known predefined time frame. In our case, 1 month. After that time, the option has no value. This predefined time frame in which the option will be exercisable is called the option's term or duration. Options that can be made exercisable at any time during the time period are called American options. Options that can be exercised only at the end of the period are called European. The person giving the right and taking upon himself the obligation, in our case Zoe, is sometimes called the originator or option writer or option seller. The technical name of an option that involves the right to buy an asset at a price is a call option. In our case, Zoe sold a call option to Bill. Options are very useful tools in business and are indeed used to help execute all sorts of transactions and help reach all sorts of business goals. Here are a few examples. A. Sarah is a real estate entrepreneur. She meets Philip, the owner of some land close to the beach, who wants to sell his property. Sarah knows of some friends who would love to buy luxury apartments in this location, which is a high demand zone and characterized by limited supply. Sarah approaches Philip and proposes a deal. The owner will award Sarah with the right, but not the obligation, to buy the land for $3 million anytime within a 24-month period. Within this time, Philip's property is off the market, and Sarah will have time to proceed. Sarah has high conviction in the project and pays Philip $50,000 for the option on the land. Sarah then prepares the plans and finds out she can build 30 condominiums. She approaches 10 friends and offers them to buy a condominium from her at $750,000. 8 agree to the transaction and are willing to commit half the proceeds up front to secure the property. Sarah has sufficient capital to secure the deal and now exercises the option to buy the land. In this case, Philip sold a call option to Sarah. B. Margaret owns a coffee shop chain. One day, a competitor approaches her with a proposal to purchase 50% of her business. Margaret is happy to accept the cash offer and negotiates a $2 million company valuation. For some reason, the buyer doesn't want to buy the whole company, and Margaret worries that differences in business approaches and management styles might pose a problem. Jeff, Margaret's friend, comes up with an idea. The buyer will purchase half the business for $1 million, but will also grant Margaret the right, but not the obligation, to sell her full remaining stake in the business for $1 million. Based on the existing valuation, times 50% remaining stake for a term of 5 years. If Margaret executes the option, the buyer must comply. The buyer awards Margaret the option, and the deal is executed. The competitor buys 50% from Moonbuck's coffee shop. Margaret is $1 million richer. The new partner demands to improve profitability and takes drastic measures such as firing 2 critical high-cost employees. Profits promptly plummet, resulting in an operational loss. Margaret is devastated, but Jeff reminds her of her option to sell the remaining stake in the company, so Margaret promptly exercises the option to sell. The partner finds to his dismay he can't back out from the deal and must shell out an additional $1 million to buy a now worthless, loss-generating business. Margaret had the option to sell her share at a price they agreed to before. This option's technical name is a put option. Think of the option recipient, Margaret in our case, putting the now worthless remaining shares in her partner's hands and taking the money from his pocket. Now Margaret can take her dream vacation and sip margaritas with Jeff.
Okay, students, so that's a practical example of how derivatives work. Let's see if I have anything on. Okay. Okay, so let's get back to topic then. So you guys basically have an idea of what options are. You now have an idea of what in the money and out of the money options are. Now, what is the difference between futures and options? So the basic difference is your losses are limited to the premium you pay in the options. So in option, you only pay a premium. In futures, you have to buy the entire asset, right? And an option is a right. You can exercise or not exercise, whereas in futures, it's an obligation. Once you enter a futures transactions, if it goes up, you have to, and you are on the right side, you make money. In the wrong side, you lose money. And in futures, the gain or loss can be potentially unlimited. However, in options, the gain can be unlimited, but the loss is limited to the premium you pay. So that is the advantage of having options. Okay. So 2 options we talked about. Summing it up, call option is an option to buy an underlying asset, whereas put option is an option to sell an underlying asset. An European option only exercisable at the time of maturity. American option can be exercised anytime. Any questions, students, on options before I go to the next topic on this? Yes, students?
No, sir.
Okay. The only thing I'm worried about is this is a good topic and many students are not here. So only 3 of you guys are here. So, so I have to pretty much redo this next time or whenever the rest of the students came. But anyway, that's that. Okay. Okay. So here are some positions that you can potentially create in an option market. Okay. Okay. By the way, students, one assignment is your simulation assignment. The next assignment, you have to come up with profitable option strategies using the Opstra Edge website. Okay, I will show you how in a moment when we get into option strategies. So that's the second assignment where you have to come up with profitable option strategies. Okay, students?
Okay, so yeah.
Yeah, I believe I mentioned that in the classes,
Yeah.
earlier
Yes,
classes.
sir. Yes, sir. Yeah.
Okay, okay. Now, so long call. What do you mean by long call? Long means you bought a call option. Bought. Long means buy. Short means sell. Okay. So when you buy an option, you pay premium. Remember that? When you sell an option, you collect premium. So most of the time, the option sellers are the ones who are making money because options are working. Most of the options are expiring worthless. In fact, 85% of the options are expiring worthless. And the NSE is one of the world's largest derivative exchanges. And this is where they make most of the money. People are buying options and they're going worthless, and the NSE is just putting the premium in their pockets. So long call, what does that mean? I am buying a call option. So I pay a premium, I buy a call option. Long put, what does that mean? Students?
Buying a put option.
Correct. So I am paying the premium and buying a put option. Short call.
Selling a call option.
So what does it mean?
We are actually receiving premium.
Yeah. So I am receiving the premium and selling a call option. I'm collecting the premium, selling a call option. Short put.
Is selling a put option.
Yeah, I'm selling a put option and collecting the premium. Now, there is one more thing that you can do. If you have stock with you, you own a lot of shares, but you think in the short term, the shares are going down. What can you do? You can sell a call option. So you have the underlying stock, you sell a call option. That is called covered call. So what you are saying is, I'm going to sell call option, maybe out of the money call option, collect some premium. If the stock goes up, what I should do is I should just give my stock. So if the stock price crosses the call strike price, which I sold, then I will just have to give my stock to my broker because I have collected the premium. So when will I do that? When I'm certainly sure the stock is not going to go up, I can sell some calls against and collect premium. So this can be like a hedging kind of a strategy or an income generation strategy. I have the underlying asset, but I think in the short run, it is going to fall. So what will I do? I will sell a call option against the stock I own. Yes. In case I'm wrong, I may have to tender my stock because it has crossed the strike price. Okay. So this is called covered call. Is that something you are understanding?
So can you repeat it again?
Yeah. So let's say I own some shares in Reliance. Okay. I think some news has come out like yesterday and the share price can go down. So Reliance is near to 2,400, right? Yeah. So what I will do is I will sell a 2,500 call. If I think Reliance is going to drop to 2,200, 300, but I don't want to sell my shares. I have long-term capital gains. I just want to keep that. So what I can do is I will sell the Reliance 2,500 call and collect the premium and just keep it. Yes. So what will happen is if Reliance, unless Reliance crosses 2,500, that premium will act like free income for me. Are you understanding?
Yes, sir. So in this scenario, why don't we buy a put instead? I mean, selling a
Okay,
call or
remember,
buying.
remember, you can buy a put and protect yourself as well. Yes, that is called long put. You can do that. No problem. But remember, you will be paying premium, right?
Yeah.
Yes, you will be paying premium from your pocket. In this case, I am collecting premium, right? So it is like an income generation strategy.
Okay.
Is that clear?
Yes, sir. Yeah.
Yeah. So that's the thing. So you should be sure though that the stock is not going to rise. Then only you can do the strategy. So if you are ready to take that risk, then you can do it. Yes, but if you think the stock is going to go down and considerably, so this covered call strategy is only for short-term downside. You think for 2 or 3 weeks it will go down near the expiry date, and then what? After that, it's going to start rising. So given you have weekly options and all that, you can sell the weekly call options. But on individual stocks, we don't have weekly options. So you can sell some nifty calls against it, possibly. You could do that. Yes. So this is a income generation strategy to take advantage of short-term moves in the market. So you can do that. Now, some people sell out of the money put options if they want to buy stocks at lower prices. So let's say today, that is called, that is also interesting strategy. So today, let's say Reliance is 2,400. Okay. You think Reliance has a possibility of coming down. Yes. But what you see is you are seeing some 2,300 options, put options. You sell those. You think Reliance will come down, but it won't come down much. Yes. But you should also have the view that if Reliance comes down below a certain level, then I am ready to buy the stock at a lower level. Suppose Reliance is 2,400. You think it may come down, but you are ready to buy it below 2,300, let's say. Yes, you don't want to buy it at 2,400. You think it will come down further, but you are ready to buy it at 2,300. So what can you do is you can sell some 2,300 put options and collect the premium. Yes. So let's say the 2,300 put option on Reliance is probably like 5 or 6 rupees. Yes. So you'll sell that and take the premium. Now, if Reliance falls below 2,300, so 2,300 minus 5, 2,295. Guess what? You will have to buy Reliance at 2,295. So this is a very attractive way to buy the stock at lower levels if it falls. So that is called selling a put option or writing. Covered call is writing a call option. Selling and writing are one and the same. These two words are used interchangeably. So
shouldn't it be selling a call because we were expecting the price to go down, right? So either we
correct.
buy a put or sell a call, right?
Okay, you sell a call, but assuming you know Reliance is going to go down, but you are ready to buy. You want to buy Reliance below a certain level. If you want to say, I don't want to buy Reliance at 2,400. But if it goes below 2,300, I'm ready to buy. For that, you will write a 2,300 put option. You will sell a 2,300. Remember, selling a put option is like buying a call, right?
Yeah.
Almost the same effect. So if 2,300 Reliance goes below, then that you can exercise that option and buy Reliance below 2,300 in the event it happens. In the event it doesn't happen and the stock stays at 2,400, the put option will go worthless and you already collected the free money as premium.
Okay, so in addition to the in addition to the first, I mean, two options, we are talking about two options, right? Here.
No, this is separate strategy.
Okay,
you can do a covered call strategy. Yes, that is a separate one. In addition, if you want to buy the stock at lower levels, some of these fund managers will sell out of the money puts with the aim of buying the stock at lower levels.
Okay.
Is that clear? Students, any doubts before I go to the next topic? Yes, students? Good to go?
Yes, sir.
Okay. So how are we going to make money if we buy a call option? Okay, so let's take a very simple example. Yes, let's take a very simple example here. So I am buying a call option of a stock with a strike price at 100. Yes, I pay a premium of 5. So there is something called a break-even point, which we can calculate. And what is that for a call option? It is nothing but strike price plus premium paid. So what is that in this case?
95
Strike price plus premium paid.
plus
Call
premium.
option.
105, yeah.
Yeah, so 105. So if the stock price crosses 105, yes, then I'm going to make money. Yes, because my option will become in the money. Yes. However, if the stock price stays below 100, I will lose the 5 rupees I paid in premium. But the 5 rupees is the maximum I can lose. Yes.
Yeah, right.
Okay. Any questions?
No,
So
sir.
the gain is potentially unlimited if the stock price keeps climbing, and the loss is limited. Is that clear, students?
Yes, sir. Yeah.
Sir.
So that is the advantage of trading options. I mean, buying options. In the futures market, if the price goes below 100 and goes to 70 and all, you will keep on losing money, right? So this is the thing. But in the options market, I can't tell you enough. You have to be right both on time and direction. If you get one wrong, your option still goes worthless. You will lose all the premium you pay. Okay. Now, shorting a call option. Remember, selling a call option. What happens? So selling a call option is when we generate premium, we just take premium, collect premium, and we are sitting. So when will you sell a call option? This is just short call.
When we expect the price to go down.
Yeah, when you expect the price to go down, you sell a call option. In this case, what will happen? You are collecting a premium. Yes. So as long as the price is below 100, we are happy because our premium is safe. But the moment the stock starts going above 110, then we are in trouble because your loss is unlimited here, right? If the price goes up above 105, the break-even point is 105, right? So once it crosses 105, you're going to be in trouble because basically your loss is unlimited. Yes, the price can keep going up, right? So you have to be careful. You have to do this strategy when you are absolutely sure the price is going down. Almost 90% you should be sure. But it's many people keep doing this, but they will not sell 100. Let's say the price is near 100, they will be selling something like the 90 call or something to be safe. Always better to sell out of the money options, guys. Let's never sell in the money options because you can be wrong anytime. It's always best to sell out of the money option in the direction of the trend. So right now, I will be selling out of the money Nifty call options, but I will not be selling out of the money Nifty put options because the trend is down. And suddenly out of the money can become in the money. So I will only play the direction of the trend, but I will sell out of the money options the direction of the trend. Is that clear? Yes, students?
Yes, sir.
Okay. Now, the next one is long put. So in put options, the break even is calculated slightly differently. How will we calculate the break even? It is strike price minus premium. So what would be the break even here? Yes, students? What would be the break even here, students? So strike price is 70, premium is 7. Yeah?
Yeah.
So 70 minus 7, 63 is the break even. So below 63, we are going to be making money. Above 63, we'll lose the 7 rupees we paid. Is that clear, students?
Okay, sir. Yeah.
Remember, put option is, you take put option when you think stuff is going down, right? So when price goes below the break-even point, 63, then you start making money, potentially unlimited money you can make till the price goes to 0. So that's the maximum. But if it goes above 63 and above 70, which is your thing, then you will lose the 7 rupees you pay. So you are wrong in direction. So that's why you should be right both in time and direction. So above 70, you start losing. You will only lose 7 rupees. Below 70, you start making unlimited gains. Is that clear?
Yes, sir.
Okay. What about short put? When will you do this strategy? When you are so sure that the market is only going to go up, you can sell puts. So here again, what do we want in this case? We want the market to go up, right? So as
Yes.
long as price stays above 70, you have happily collected 7 rupees and you are sitting. But the moment the price starts going down below 63, then you have to be on your toes, because then you are starting to lose money and the loss can be potentially unlimited.
Yeah.
Yes, students?
Yes, sir. Got it.
These concepts clear to you?
Yes, sir.
Yes, sir.
Anything else you want to know about options? We'll get slowly and steadily. There are a lot of strategies and options which you can apply. Okay. Okay, so that's a summary of long call, long put, short call, short put. Okay, now options are not just available on stocks and indices. You can have currency options. Sometimes you have options on futures. You can have commodity options. We have options on commodities. You can even have options on interest rates and options on swaps, which are called swaptions. Okay, so many asset classes and even derivatives have options on them. Okay, so every option has these characteristics. Every option will have an expiration date. So next Thursday will be an expiration date for index options, Nifty and Bank Nifty. every option will have a strike price or a exercise price in which the option can be converted to shares at that price. Every option is either European or American. Most Indian options are European. And option will either be a call or a put. Okay, students?
Yes, sir.
Yeah. So I already discussed this concept of at the money option, in the money option, and out of the money option with that Google example. Yeah. So let's look at a Nifty at, let's say if Nifty was 8,800 in value, at the money option would be Nifty 8,800 call and put. In the money option would be Nifty 8,700 call, Nifty 8,900 put. Remember, for in the money call option, what should be the case? Market price should be greater than strike price. And for the put option, strike price should be greater than the market price for in the money. And out of the money is what? The reverse. Yes, the market price should be less than the strike price for the call option. And the market price should be greater than the strike price for the put option. Is that clear, students? Just summing up.
Yes, sir.
Yeah.
Yes, sir.
Yeah. So we discussed the concept of intrinsic value. Yes. Option class. Yes. An option class is whether it is a call option or a put option. An option series is the entire option for the month. So an option, the July series, if I say, it is all the options of that underlying asset for that series, both call and put options. Intrinsic value is market price minus strike price for call options, and strike price minus market price for put option, and then time value. Yes, it's the time to expire. Okay, so now let us look at a video which talks about some important concepts in case you are trading options. Okay, so this is an interesting video, I thought. So I will.
Now that you understand why options exist, I'm going to show you ways you can trade options to make a profit.
Hold.
So most of your favorite companies that you use every day have stock options, and you can trade them right from your computer, cell phone, or tablet. There are two types of options. There are calls and puts. If you buy a call, you want the stock to go up. If you buy a put, you want the stock to go down. Now, since there are two sides to every market, you can also do the opposite, where you would sell the option as an opening trade and hopefully buy it back at a lower price as a closing trade. This will make more sense in a second. Option prices are based on three elements of its underlying stock. The first one is time to expiration. In the last video, we talked about how options are basically insurance, and of course you pay money for this insurance. Now, the thing about insurance is you don't just get to pay a one-time payment and have insurance forever. You have to pay month after month to keep your insurance. So the longer you have it, the more money you will have to pay. Options are the same way. They have expiration dates for the exact same reason you have to pay monthly for car insurance. An option with 60 days until expiration might cost $500 when the option with only 30 days to expiration only costs $250. So more time equals more money. So naturally, as time passes, An option's time value will decay. This is known as time decay. Now, let's take a look at how an option's time value will decay over time. The curve will look something like this. As you can see, time decay isn't linear, it's exponential, meaning that as you get closer to expiration, time decay will rapidly speed up. The important thing for you to understand right now is that an option's time value is always decaying, 100% of the time, every day, every hour. This can be your worst enemy if you trade options the wrong way, or it can be a huge advantage if you trade them correctly, which I'll show you in the next few videos. Most stocks have options with weekly, monthly, and quarterly expirations, and you can choose whatever expiration you want to trade in. And in some of my other videos, I talk about the best expiration that provides the lowest risk and the highest returns, so be sure to check those out. So the second factor that goes into option pricing is the price of the underlying stock itself. For each stock, there are multiple options at different price increments. These are called the option's strike price. The strike price is the predetermined price at which the shares of stock will be exchanged if the option is exercised. For example, if you own the stock at $125 per share, you could buy the 125 put because that's where you could sell your shares in case the stock goes lower and you need to exercise your option. So again, the strike price is simply the price that the shares of stock will be exchanged if the option is exercised. Of course, you don't have to own shares of stock to trade options, but the strike price of the option you're trading has a huge effect on what the option's price will be. Let me explain. Let's say the current stock price is $125 per share. For call options, any option that has a strike price above the current stock price is referred to as out of the money. If the strike price is below the stock's price, it is referred to as in the money. And for put options, it's the exact opposite. I know this is a lot to digest right now, but soon it will become second nature. So here's an idea of what each option's price will look like with, let's say, 30 days to expiration. And just a quick note, each option contract represents 100 shares of stock. So these prices have a multiplier of 100. So, for example, if you buy one contract of the 125 call, this will actually cost you $500, not $5. So here's the thing. All out-of-the-money options have no value at expiration. Let me repeat. If an option is out of the money at the expiration date, it will be worthless. So if they won't have any value at the expiration, then why do they have value now? Because stock prices move, and there is a chance that the out-of-the-money options could become in the money if there is still time left to expiration. Now you can see that the further out of the money an option is, the cheaper it is. That's because the likelihood of it being of any value is less than an option that is closer to the stock price, right? Because, for example, this stock is more likely to get to 130 than it is to 135. And as stock prices move on a day-to-day basis, the option prices will also move. If the stock goes up, the calls will become more expensive and the puts will become cheaper, and vice versa. Now, a common misconception is that you have to hold your position until the expiration. This isn't true. If you buy a call option today that expires in 30 days and the stock goes up overnight and your call option is now worth $100 more than it was when you bought it, you can sell it for a profit. The expiration date of 30 days does not mean that you have to hold the position that long. Now, you see the prices of these options with 30 days left until expiration. Let's take a look at what these option prices will look like with 0 days left. You can see all out-of-the-money options are worthless, and the in-the-money options are worth the difference between the stock and the strike price. This is because since there is no time left, there is no time value left on these options. This is also referred to as extrinsic value. The third and final factor that goes into option pricing is volatility. Volatility is referred to as the magnitude of a stock's price swings. Higher volatility means bigger price swings and ultimately more risk for the investor who owns stock. Since there is more risk involved, options will be more expensive. Why would the option seller not demand more money if they're taking more risk? Let me explain. I know you're probably sick of the insurance analogy by now, but let's say you are providing life insurance for two different people. The first person is overweight, smokes a pack a day, and has a medical condition. And the second person is healthy, exercises regularly, and has no signs of any life-threatening medical conditions. Now, who do you think will have to pay more for life insurance? Exactly, the person who is at more risk of dying. Now think of this person as a stock with high volatility and this one as a stock with low volatility. Now, different stocks have different volatilities, but volatility is something that moves around. A stock with low volatility now might have high volatility in the future. Volatility is much more predictable than stock prices, so if you're trading options, it's important to position yourself on the right side of volatility. This is the backbone of my trading strategy, which you'll learn about in the next few videos. And the combination of these three elements is what determines option prices.
That's a nice summary of what we discussed. That should have cleared some doubts you guys possibly had in case you were having some minor doubts. So the video format is interesting because it will always, show you some visuals, which is sometimes better than the class lecture. So hence I play a video every now and then to clear things up. Okay, there we go. Okay, so dividend payments usually are reduced from the strike price. So there is a concept of companies going ex-dividend. So meaning, so if dividend payments happen, those are reduced from the strike price. So that's all you should know for now. And sometimes stock splits happen, then usually the option lots change. Okay, new option contracts start trading for the next month. Okay. Okay, so option markets, nowadays options you can be bought and sold online. Yes, so same way as stocks are sold, options are also sold. Okay, margins are not required for you to buy options, but when you are selling options, margins are required. Yes, so selling options, when you sell options, remember, there is a risk that you could lose more than you basically sell because the price could move the other way. So whatever you sell, that plus the underlying percentage share of the underlying asset should be collected upfront. The exchanges collect upfront. When you sell options, you sell calls or sell puts, whatever you sold plus a fraction of which the shares either out of the money or in the money is collected as margins by the exchange. So this, don't worry, I will show you how all these things work in a minute. Okay, so originally the concept of options originated to create to help people purchase shares, etc. So today, you've heard of ESOPs, anyone? Some of you may even have it. Yeah. So
Yes, I've heard of it. Yeah.
Yeah, so companies give employees stock options. These are typically out of the money call options. Yes, so you work for a few years. If the company share price appreciates and crosses that out of the money price, then the options become in the money and you get a very good bonus because your shares now have more value and your options can be exercised and converted to shares. So ESOPs are a good way to retain talent. Okay. So sometimes what happens, a company issues ESOPs, but recession comes and the stock price actually goes down. So these options will stay out of the money. Then the company will have to backdate these options, go back and reissue. Yes, reissue new options to the employees. Otherwise, the employee would be frustrated. right? He has worked so hard. He thinks he gets a bonus, but the options are out of the money. So yeah, the company will have to backdate these options. Okay. So here are some notations which you guys must be aware, because for some calculations which we are going to do, these will come in handy. So this general symbols are this. We will only look at the European side of things. We are not too keen on the okay. So so these variables, D is dividends, I think. What is D? Present value of dividends. Yeah. So these variables have a direct bearing on the option premium or the option pricing. Yes. So anyway, don't worry too much about it, but you must understand one important thing. So for put and call options, the volatility or sigma you see there is very, very important, regardless of whether the market is going up or not. If the volatility is high, there will be a higher option premium. So that is something you must know. Okay, just leave on. Okay. So this is something called, there's something called put call parity. Yes. Sometimes you will see, I will explain this. I'll play a video first and then explain this concept. It will be better actually.
Win at work by communicating effectively with Grammarly. Meet Ty. He is emailing a difficult client.
Hi.
Put call parity links the price of a European call option with its corresponding European put option, subject to some conditions. I'd like to show you first an elegant way to understand why put call parity even applies, and we'll do that with a synthetic forward. And then secondly, to be more practical, I'll show you the way that I memorize put call parity. Put call parity gives us a necessary relationship between the price of a European call option and the price of a corresponding European put option. In my example, the call price is $2.44. I've colored it in light blue. And the price of the European put, the corresponding European put, is $1.66. Now I have priced these according to the Black-Scholes Merton. Those are in hidden rows if you want to download the spreadsheet and see how I did that. But my focus here is not the valuation. We don't need to do that here. I did use all 6 of the classic inputs into that model. And there is a condition for put call parity to apply for us to be able to rely on it. Easy to forget this. The condition is that the call and the put are European and that they are on the same asset with identical strike price and maturities. So in my example, the strike price is $20 and the maturity or term to expiration is 1 year. So both of the call and the put need to have the same strike price and the same term to expiration, which they do here. If they share identical strike and maturity, then put call parity will apply. I think an elegant way to understand this is by way of the synthetic forward. So over here, I've started here a profit diagram, and I'll start with the long call, which is illustrated here in the dashed blue to match this blue here. So this is a profit, not a payoff, and by profit, I mean it includes the receipt or payment of the upfront premium. And so you can see for the long call here, under the x-axis is future stock prices. So at low future stock prices, that is below the strike of 20, we have here a net loss on the long call equal to the premium. That is, we bought the call, we paid $2.44, but it expires underwater. We don't get to exercise it. So we just have the $2.44 loss. On the other hand, if the future stock price is higher, then we start to enter into net profit territory for us. And the break even, in fact, will be, we can easily see the break even. It's $22.44 because at future stock price of $22.44, we would exercise for a $2.44 payoff minus the premium we paid of $2.44 gives us a zero profit. Okay, then I'll add now a short put position. So this is not buying the put, this is writing or selling the put, and its diagram here at higher future stock prices shows a flat net profit equal to the premium collected. After all, we sell the put today, we collect $1.66 at future stock prices above the strike price. It expires worthlessly for our counterparty, and we just pocket the premium, as they say. On the other hand, if the future stock price is below the strike price, then we start to incur a net loss because our counterparty will exercise, which is to say, we're obligated to pay the strike price in exchange for receiving the stock. And the break even we can also see here is going to be at the $20 strike minus the put premium of $1.66. Looks like that's about $18.34 as the break even on the downside. Okay, so now this is a portfolio of only two positions, long call plus short put. That portfolio, again, it has a net profit profile as illustrated by the purple line, and you can visually see why that's the case. And this is the synthetic forward, because buying the call and writing the put is a portfolio that together has a profit profile that's identical to a forward. So we could say it's a synthetic forward. And our synthetic forward looks like buying the call is positive C minus P because we're selling or writing the put. That's our synthetic forward. The one other thing we could add to this is, let's say instead of exercising the options in a cashless fashion, let's say instead of a cashless exercise, we exercise to hold the asset. Meaning, if the future stock price is above the strike price here, we're going to exercise the call option, meaning we're going to pay the strike price and receive the stock. Of course, our strike price in the future will be that $20, and at higher values up here, we're going to receive a stock that's worth more, hence the profit. But also here on the downside, if the stock, say, is down at $15, we have written a put, meaning we also will be paying the exercise price, but in this case, in exchange for the stock that's worth less. And so by adding the future strike price that we will pay under any scenario, we've synthesized here the stock position, right? This buy the call, write the put, synthetic forward, but add cash equal to strike, and we synthesize the stock. And then here we have the elegant approach, I think, to put call parity. The only difference is, well, so these three are equal to S0. The only thing is my stock today is present value, my call is present value, my put value is present value. So I want to present value that strike price, which is going to occur in the future, right? So I take e to the negative RT, typical action there to present value in continuous compounding. And there we have this approach to put call parity that says the price of the stock is equal to its synthetic equivalent, or portfolio of buying the call, writing the put, and present value of cash to be paid in the form of the strike price. So that means that just in terms of applications now, that means we can rearrange this in any way, right? If we want to solve for the call, we do need to know the put price, but if we know the put price, then we can take stock price plus the put price that we know, $1.66, and subtract the strike price discounted at the risk-free rate, and we get the call price. On the other hand, let's say we know the call, but we want to solve for the put. Well, then we can take the call price that we know, add the strike price discounted at the risk-free rate, and we would just need to then finally subtract the stock price, and we solve for the put price. Okay, so that's the understanding, and then I'll just flip to my next final slide just to show you, if it's helpful, how I memorize it. I memorize it differently. I've covered this in an old video of mine.
Okay, students, never mind all that logical explanation, but what it simply means, put call parity, is, so basically if you have a stock and a call and a put option having the same maturity date, yes, call and a put option having the same maturity date and the strike price, you should technically be able to calculate the value of the call option from the value of the put option, or vice versa, using this relationship. Okay, students. So technically, the call options value should be calculatable from the put options value, and the put options value should be calculatable from the call option value. Remember, the criteria for put call parity is they should be European option, yes, and they should have the same strike price and expiry date. Okay, so then you may ask me, so why on earth do we even have to worry about this? The thing is, sometimes you may get arbitrage opportunities. You may be able to calculate from the call option the put option price value, but in the market, the put option value may be something else. So there is possibility of arbitrage. Hence, this parity relationship is very, very useful. Is that clear, students?
Yes, sir. Yeah.
Yeah.
Yes.
Yeah. So that's why put call parity is important. So let's look at an example. Okay. So here's an example. Is there any option using put call parity? Can we engage in some kind of arbitrage? Is there an opportunity even? Yes. So have a look. Exercise price is 1,500. Current share price is 1,490. Call option is 170. So 150, 1,500 call option is 170. But the 1,500 put option is 85 only. Does that look odd to you? Yes, no? No? Which is in the money, students? Call option or put option here?
Put option.
Yeah, put option is in the money, right? So why is the put option priced less than the call option? That means there must be an option arbitrage possible, right? It looks a little out of it. Let's look though. Let's do the calculation. Okay, so use this equation right here. Yes, let us calculate the call option. Yes, theoretical price using the put option value. Let us assume we are calculating the call options value. If you do that, you will get the call options value as 112. But the actual call price is what?
170.
170. So what can you do?
Short the call.
Yeah, basically you short the call. Yes. And you basically buy the put and you profit 58 rupees. Basically, that's it. You can do the reverse also. You can calculate the put option by putting in the value of the call option. Yes, and you will get a much higher value than 85. You can do that also. Okay. All right. So arbitrage possibility is there. So if you use the 170, yeah, call option and find the exercise strike price. Now assume based on what is given, what the correct value of the actual exercise price should be. So in this case, what will be there? You will get an exercise price of 141. You can do it this way as well. You'll get the same result actually. So actual exercise price was what? 1,500. The theoretical exercise price 141. If you do that, you will get the same 58. It should come to be the same 50. So the arbitrage opportunity is 58 rupees. It is unusual to see this, but sometimes in the market, you will see this. And to take advantage of that, you can always look at put call parity. Yes, students, is that clear?
Yes, sir.
Yeah. So you have to know exactly what to sell and what to buy. In this case, the call option is overpriced and the put option is underpriced. Okay, students. So assuming you sell the call option and you sell the put option, and if both go worthless, you will still end up making 58 bucks. Yes, students? So buy the call option buy the put option in this case and sell the call option and pocket the difference. So call option is way overpriced in this case. So arbitrage profit is about 58. Any questions, students?
No, sir.
So every now and then, if you watch, you will come across these opportunities in the market. So you can take advantage of this. Okay. So why do people sometimes buy American options? Because sometimes they want to exercise early. Yes, in case they want to buy it, portfolio managers may buy call options with the aim of buying a large amount of shares. So if they want to not wait for the maturity period to exercise, they can exercise early. But most of the options are traded and not exercised. Remember, most people like us, we don't have the money to exercise options. You require huge amounts. So most of the time we are just trading and making money and exiting. Okay, before I go to trading, I want you to know a concept called maximum pain. Okay, the maximum pain level. Mahesh, do you know about this? Have you heard of this maximum pain level?
No, sir.
Okay, so this is something that you must know. If you're trading options, you must know. So the maximum pain level is a level in the market which causes on the expiry date maximum pain both to buying and sellers of options. So if it goes either side, yes, it can create problems. But how can you use that? So basically, I'll play a video on maximum pain to help you understand the concept. So basically, very, very interesting. So if the market is usually above the maximum pain level, then it is a bullish sign. However, if the market breaks below the maximum pain level, then it can be construed as bearish. For example, I will show that to you in the context of Nifty, and I will also play a video on maximum pain level.
Hey guys, how's it going? Solo back here. It is August 1st, which is a Saturday, and today I want to make a video talking about max pain theory. So what is max pain, or what is the max pain price? And what it is the max pain price is the strike price with the most open contracts of both puts and calls, and the price at which the stock would cause the most amount of financial loss for the largest number of option holders at that day of expiration. So basically, it's the strike price or the option price that would cause the most amount of pain financially for both buyers and sellers of puts and calls. So the max pain theory suggests that the options price is going to gravitate towards the max pain price, and in some cases it may equal that strike price, which would cause the maximum number of options to expire worthless. So some people think of this as a way for the market makers to inflict the most amount of pain on option buyers and sellers. So the way to calculate maximum pain, you just add up the dollar values of all of the outstanding puts and call options for each in the money strike price. Most traders who buy and hold options contracts until expiration are going to lose money based on maximum pain theory. This is due to the tendency of the price of the underlying stock to gravitate towards its maximum pain strike price. So again, that's going to be the price where the highest number of options in dollar value will expire worthless. So maximum pain theory says that the option writers or the sellers will hedge the contracts they have sold, and in the case of the market makers, the hedging is done so that they remain neutral in the stock. So if you consider the market maker's position, they have to sell an option contract without wanting to get assigned shares of that stock. And as that option expiration date comes closer, option sellers will try and buy or sell shares of stock to drive the price of that stock towards a closing price that is going to be profitable for them, or at the least to hedge their payouts to option holders. So sellers of call options are going to sell shares to drive the share price down, and put holders will buy shares to drive the stock share price up. So the maximum pain price, strike price, is going to exist somewhere in the middle here. About 60% of options are traded out or closed early, about 30% of options expire worthless, and about 10% of options are exercised, according to Investopedia. So the maximum pain price is the point where option owners or buyers feel maximum pain or will stand to lose the most amount of money. Option sellers like us, on the other hand, may stand to reap the most rewards. So obviously this is a controversial theory. Some of it might be like a conspiracy theory if you want to think about it that way, but there are people that believe in maximum pain and may or may not choose to avoid the maximum pain strike price when they decide to trade options. So the way to calculate maximum pain is going to be time consuming, right? But there are actually websites that I'm going to show you right now that will do this for you automatically. So what you have to do if you really wanted to do this by hand was for each in the money strike price for both puts and calls, you have to find the difference between the stock price and the strike price. You're going to multiply that number by the open interest at that strike, and then you're going to add to it the dollar value for the put and call at that strike. And then you're going to do this for every single strike price, basically for every option on that stock. And what you're going to do is you're going to find the highest value strike price, and that's going to be your max pain price. So obviously this max pain price can change daily or hourly, because every minute of every trading day while the market is open, new option positions are getting opened, other option positions are getting closed, so it's always in fluctuation. So one of the websites that I will refer to from time to time is swaggystocks.com. So it's SWAGGY stocks.com. And what you can do is you can type in the ticker here. So let's just use SPY as an example. You're going to choose the expiration date. So let's choose this coming Monday, which is August 3rd. And as you can see, it'll show you in bar graph form the volume or the number of calls and puts that are open right now on SPY. And it also will show you in the bottom right corner that the max pain price for SPY for the options expiring this Monday, August 3rd, is $322. So as you can see, it's very close to where the number of calls and puts are relatively equal. It's 321, 320. So just by visually looking at this graph, you're going to know the maximum pain price is somewhere in the low 320. And like I said, this website is calculating it to be 322. So you can do this with any ticker. So if we want to take good old AMD, for example, we can do AMD. We can do the option expiring next Friday. And we can see the max pain price for AMD is $70 for this coming Friday. So it's up to you how you want to decide to use this information, if you want to choose this information. So the way I somewhat interpret this is saying that, okay, if I believe in this theory, that means that the market makers or these big institutions are going to try and pin the stock at a share price of $70 this coming Friday for AMD. So if I'm an option seller, then that tells me that I definitely want to sell a put on AMD that's below the max pain price. Because if I were to sell a put at, let's say, $72, and if the max pain price is $70, so I take that to mean that the market makers are going to try and drive the price down to 70, well then that means that I'm going to be in the money and I might get assigned shares of AMD. So you can use this as a quick and dirty frame of reference as to where you want to sell your cash secured puts. Or on the flip side, you can use it to determine where you want to sell your covered calls as well. For example, let's say you own shares of AMD at the $60 cost basis. So you own shares at $60 each, and you want to sell a covered call on it for profit. Well, I would use this and say, well, let me sell a covered call above the max pain price. So let's just say $72, because if the market makers want to drive the price to $70, if I don't want my shares called away, I want to be above the max pain price. Now, if you do want your shares called away, maybe you want to get out of that stock, maybe you want to free up collateral to open up new plays, I could say, well, you know what? I own my shares at 60. Let me sell a covered call at 69. That way, if the market makers do drive the price to 70, I'll be in the money, meaning I can collect stock appreciation plus the premium. And in theory, if I'm at 69 strike and the stock price goes to 70, then my shares should get called away. So that's how you can use max pain theory in terms of options trading, and especially for us in ThetaGAN, determining what strikes you want to pick if you want to sell cash secured puts or if you want to sell covered calls. I will say I don't necessarily trade based off this, but I will peek at it because I think it's an interesting number, and maybe it's all psychological, but it just makes me feel a little bit better knowing that I'm below or above the max pain price, depending on if I'm selling puts or selling calls. So it will be interesting to do kind of a back test to see how often this max pain price is correct. I mean, we could see if we go to yesterday's expiration date, 7/31, this website calculated the max pain price to be $67. And if you want to see where AMD closed, AMD actually closed at $77.43. So in this instance, clearly this max pain price was way off. It was off by about $6 or $7. So again, this is all theory. I would consider this technical analysis somewhat, I guess. It's more data analysis, really, I would say, than technical analysis. But as you can see in this example, it's not always 100% accurate. I mean, let's just take a look at another example here. We can look at IWM, and we can compare the max pain price. So the max pain price for yesterday, July 31st, was $146. So again, that tells us that in theory, the market makers are going to try and drive the price to $146 per share on the day of expiration. So let's see where IWM closed. So IWM closed pretty close. It closed at 147.36. So in this case, it was pretty darn close to the max pain price. So I'm just here presenting you the information. I'm not telling you that you should use max pain price. I'm not telling you that it's always accurate. It's up to you to decide if you choose to look at it or not. But I just find it interesting that data like this honestly even exists. But there are people that I will say that I know are trading based off the max pain price. So let me know in the comments below if you've ever heard of max pain before. If you have, do you use it consistently to trade your options? Or do you think this is all just kind of hocus pocus?
Okay, students. So let us see how we can use this max pain price as the in the Indian context, and look to see whether we can learn something from it. So I will go to niftytrader.in. Students, are you there still with me? Yeah.
Yes.
Okay. So I will look at, so basically, max pain level is very crucial. Okay. So if you are in an uptrend, yes, price will usually be above the max pain level. Okay. Particularly, it is very, very useful. So let us look at where the max pain graph is. Okay. So click options, Nifty open interest. Live max pain chart for derivative stocks. Click here. Okay. For any stock here, you can get the max pain level. Okay, students. So now look, this was the last day of Friday. And what is the max pain level, students? Can you see? Yes. What is written there? Hey students, are you there?
Yes.
Okay, can you see the max pain level?
15,700.
Yeah. So 15.7, the market actually broke below 15.7 in the morning. Okay. So that was a sign that the short selling was probably starting. But at the end, it broke above 15,700. So as long as the price is above the max pain level, for that particular day, at least it is bullish. Okay. Remember, don't use this in isolation. Use it with other strategies. So how do I use this information to take a trade is the question. So first of all, you should be very clear with the overall trend in the market, students. Yes. So if the market is going up, price is going up and above the max pain level, long strategy will work. So buy call options may be a good strategy. Okay. So now tell me, students, what is the trend in the price of late in the Nifty?
Down, sir.
Yes, down. Yes, down. But in the last 2 weeks, it has made a small up move. So overall trend is down. Last week trend is up. So I am going to basically look for selling opportunities. Yeah. So the day my price crosses below the max pain level. Yes. Give it a day. I see the price in the short run, the market has gone up. But if the price crosses below the max pain level, I can possibly look for a change in trend and go for the shorting move. So that's the good way to look at it. Remember, you need the overall trend to be on your side. There's that famous saying, right? Trend is your friend till it ends. Yes, trend is your friend till it ends. So basically the trend, overall trend is still down. Short-term trend is up. I'm looking for a reversal. Price goes below max pain. I am going to be short. Particularly interesting, price is above the max pain in the morning. Afternoon, it is below the max pain level and going to close below. Then the next day could be potentially down. So this is how you can use maximum pain level, right? So max pain level, remember, is the level that creates most pain for option traders at a particular strike. So 15,700 closed above that, right? So also have a look. So the max pain chart looks something like that. Yeah, you can see how open interest is also lining up. Yes, heavily there, right? So if you look, that 15,700 level will have usually the highest open interest because it's a critical level. Both bulls and bears are battling. Bulls wanted above, price above, bears wanted below. Yes. So let's click this and see what. So here's a max pain analysis chart for TCS. So the max pain level is 3620, 3620, and you can see how the price is way below that. Yes. So and if you look at the graph of TCS here, okay, TCS is showing me an uptrend. Yes, I don't know whether the max pain level is correct here. In case it is correct, yes, that's why I rather look at Nifty. It's too, I don't know whether that level is correct. It's very far away. Maybe look at Nifty itself. So interestingly, you can see how the middle Bollinger Band we talked about is near 15.8, right? So Monday, how do I approach this? Check the max pain level. It changes day to day. If I'm seeing that my max pain level is still at 15,700, if price again violates 15,700, then I am thinking that the uptrend may be over, and then look for short positions. Because the trend is clearly down, right? Yes, never go against the main trend. Use max pain or anything else to complement the main trend. Okay, students?
Yes.
Okay, students, any questions on whatever has been discussed today? Yes, no?
No, sir.
Manav, you can catch up with the others on what has been covered. And if any doubts, you can revert to me. Any other questions or issues, students? Since I didn't give you a break, I'll leave you early 15 minutes. That has always worked for me. Because when I'm in a rhythm in a class, sometimes when I take a break, I kind of lose sight. So I hope that's okay with you guys. The current format is okay with you?
Yes, sir. No.
Okay. And your thoughts on the class, anything different you want? Anything else you want?
No, sir. The current format is good. So it's a mix of practical as well as
Yes.
some concepts, right? So yeah, that's
So
working
the
good.
practical aspect of the class is very important. I think you should practically be able to apply what I teach in my class. So hence I spend a lot of time on market direction and relating it to what is happening outside, right? So that's something that you guys need to be aware of. So anything else I can help you with? Feel free to message me anytime, WhatsApp.
Sure, sir. So that second assignment on option trading strategies. So you'll be explaining that in the next class, or?
Yes. When I'm talking about option strategies, we will use that platform to do option strategies. Then you guys will get a hold of it.
Okay, sir. Yeah.
Yeah.
Yeah. Yes, sir. Thank you.
Okay. So thank you very much. If there is anything about the class you want to confidentially say something, please do write to me. Yes, I take all feedback positively to improve. So it's very, very important, because my MBA students are a little, what do you call, more on the naive side than you guys. You guys have experience. So obviously I have stepped it up a bit here, but in case some concepts go over your head, do let me know.
Sure, sir. Yeah, definitely.
Okay, students, then all the very best to you for the next week, and see you next Saturday.
Thank you.
Okay, sir. Thank you, sir. Thank you.
Bye.
Have a good weekend. Yeah.
You too. Bye.